Today, will rate cuts save mortgage defaults from rising further? Hello again, it's Martin North from Digital Finance Analytics, one that is post covering finance and property news. We've been tracking the financial pressures that many households are under, and we've signalled a slight but detectable easing thanks to 2 rate cuts and inflation easing lower. But mortgage defaults are still remaining relatively contained thanks to households prioritising mortgage repayments over other spending and banks providing support via interest-only loans and other restructuring techniques to keep them off the default list, even if longer repayment terms means households pay more interest in total. But now, Fitch Ratings has reported a sharper than expected seasonal rise in Australian mortgage arrears in the first quarter of 2025, driven by ongoing cost of living pressures and high interest rates. They analyse mortgages in securitised pools, so it's a bit of a self-selecting subset of all loans out there, but they say that conforming mortgage arrears, that's 30 days plus, rose 23 basis points to 1.36%, while non-conforming arrears jumped 39 basis points to 5.32%. Arrears among borrowers with non-conforming mortgages often are those with a lower credit rating. While arrears rates normally rise at the start of the year due to post-holiday financial pressures, this increase is nearly 3 times the typical seasonal rise, which averages around 8 basis points in the first quarter. Fitch rightly attributes the spike to the cumulative impact of prolonged high interest rates and persistent inflation straining household finances. As I highlighted, people can muddle through for months or years by cutting back on other spending, putting more on credit cards or raiding savings if they have them. A recent report found around half of households have less than $1,000 in free and available cash, which highlights the day-to-day pressures on many. Now, we should note that while arrears worsened in the first quarter, recent RBA rate cuts in February and May have not yet been reflected in that data. So we should see some pressure easing on mortgage performance going forwards. In fact, Fitch also anticipates another rate cut before the end of the year. Now, of course, you can spin this however you want. Property research firm Cotality, formerly CoreLogic, described arrears as remaining constrained despite the pressure from rates and the cost of living. According to Cotality, the string of rate rises over the past few years meant a borrower with a $750,000 mortgage saw monthly repayments rise by about $1,550 between the low point and the high point of the rate cycle. Tim Lawless, the research director at Cotality, noted most borrowers were keeping on top of mortgage repayments, and the small rise in arrears from record lows was not concerning. Now, he attributed the lower than expected rise in arrears based on different data to tighter lending buffers, less risky loans being issued, as well as strong employment rates despite the pressure of elevated interest rates and higher cost of living. Cotality cites different data, not from Fitch, but from the prudential regulator APRA, which showed that the proportion of borrowers overdue or impaired on their mortgage repayments increased to 1.68% in the first quarter, which is still below pandemic-era peaks and international benchmarks. Cotality also attributed the low arrears rates to the mortgage serviceability buffer. That's the rate set by APRA that assesses prospective borrowers' ability to repay a mortgage at 3 percentage points above the current mortgage rate. And by the way, lifting the buffer from 2.5% to 3% in October 2021 helped to lower the default risk, even though mortgage rates have risen a lot more than the 3 percentage points from their 2022 lows, Lawless said. And he also noted that although interest rates are now falling and expected to reduce further, there has been no sign from APRA that the serviceability buffer will be lowered. A further reason for lower arrears is a strong labour market allowing people to keep paying a mortgage even when repayments rise. May's unemployment rate was 4.1%, and underemployment, which measures workers who want to work more hours, also remained low, although we question the basis of those figures. See my earlier post. Cataldi also noted that high household savings during the pandemic and an anecdotal tightening of household budgets may be helping mortgage borrowers stay afloat amid cost of living pressures. Of course, while the household savings ratio held above 10% between the middle of 2020 and early 2022, it's since fallen, and savings are not equally spread across the total household population. Rather, it is concentrated among those without large mortgage or rental payments. Lawless also said interest-only loans make up less than 20% of lending in the first quarter, and that high loan-to-income and high debt-to-income lending was well below pre-pandemic rate heights at 3.1% and 5.8% of loans respectively. Now, of course, property prices are tipped to hit record highs in 2025 through 26, creating more pain for first home buyers and profits for sellers. That's according to Fitch. The average home in Australia has surpassed $1 million for the first time, according to the ABS, after contracting in the first quarter of 2024 and then growing in the first quarter of 2025. Fitch Ratings predicts home prices will continue to rise in 2025 thanks to limited housing supply, falling interest rates, and net high migration in the previous 2 years. The median house price in Sydney is forecast to jump by another 7% in 25 to 26 to $1.83 million by June 2026. That's according to Domain's latest price forecast report. This means that the typical house price in Sydney will rise by about $112,000, which is more, by the way, than the average full-time worker earns before tax, which is around $103,000. As to interest rates, the next decision on interest rates will be made by the Reserve Bank's Monetary Policy Board on July the 8th. As AMP shows, markets are expecting up to 4 cuts over the next year as inflation hangs lower. This was reinforced by the latest monthly data on inflation from the ABS, which was released today. They reported that the monthly CPI index rose 2.1% in the 12 months to May 2025. This 2.1% annual CPI inflation in May was down from 2.4% in April and the lowest since October 2024. The largest contributor to the annual movement was food and non-alcoholic beverages up 2.9%. That was followed by housing up 2% and alcohol and tobacco up 5.9%. When prices for some items change significantly, measures of underlying inflation, like the annual trimmed mean and CPI excluding volatile items and holiday travel, can give more insights into how inflation is trending. Annual trimmed mean inflation was 2.4% in May 2025, down from 2.8% in April. This is the lowest annual trimmed mean inflation rate since November 2021. The CPI excluding volatile items and holiday travel measure rose 2.7% in the 12 months to May, compared to 2.8% in the 12 months to April. The 2.9% annual inflation for food and non-alcoholic beverages in May was down from 3.1% in April. Prices for food and vegetables rose 2.8% in the 12 months to May, down significantly from 6.1% in the 12 months to April. Fruit prices fell 2.7% in the month of May, with lower prices for mandarins, oranges, avocados and apples. Non-alcoholic beverage prices increased 5.2% in the 12 months to May, and non-alcoholic beverage prices remain high, with coffee, tea, and cocoa prices up by 8.3% over the past 12 months. Higher prices for coffee drove the rise, with adverse weather conditions impacting major overseas coffee growing areas. Annual housing inflation was 2% in May, down from 2.2% in April. Rents rose 4.5% in the 12 months to May, following a 5% rise in the 12 months to April. That was the lowest annual growth in rental prices since December 2022. Consistent with smaller increases in advertised rents and stable vacancy rates across most capital cities. New dwelling prices rose 0.8% in the 12 months to May, down from 1.2% in the 12 months to April. This is the smallest annual growth since April 2021, as project home builders offered discounts and promotional offers to entice businesses. Electricity prices fell 5.9% in the 12 months to May, compared to a 6.5% fall in the 12 months to April. Electricity rebates lower the cost of electricity for households. In Victoria, the impact of those rebates was lower in May than April due to the timing of payments. And within the Commonwealth and state government rebates, electricity prices would have, on average, risen 2% in the 12 months to May, the ABS said. Automotive fuel prices fell 10% in the 12 months to May and are at the lowest since September 2022. In monthly terms, fuel prices fell 2.8% in May due to lower global oil prices at that time. Across capital cities, the average price for unleaded petrol in May was $1.73 a litre. This is 20% lower than 12 months ago and significantly below the peak monthly average of $2.07 per litre in September 2023. Holiday travel and accommodation prices rose 0.6% in the 12 months to May, following a 5.3% rise in the 12 months to April. And in monthly terms, holiday travel and accommodation prices fell 7% in May, following a 6% rise in April. That was driven by domestic holiday travel and accommodation, with a fall in demand following Easter and the April school holiday period. Insurance prices rose 3.9% in the 12 months to May, after a 7.6% rise in the 12 months to April. The annual price increase continued to slow for insurance, particularly for house and motor vehicle insurance. The 3.9% annual increase for May was well down from the peak of 16.5% in April 2024. As a result of all this, economists at CBA, Deutsche Bank and Royal Bank of Canada were among those who've brought forward calls for the RBA's next easing to July. Today's monthly CPI print capped off a flow of data that should provide comfort to the RBA that a swifter return of the cash rate to neutral is both manageable and needed. CBA's Belinda Allen wrote in a note, the decision to cut the cash rate in July, though, is still going to be a close one. While the monthly gauge isn't as comprehensive as the quarterly data that guides central bank policy, it does give the RBA officials a sense of the trajectory of consumer prices. Still, with the Trump administration's tariff regime threatening global activity, inflation is likely to begin to take second place to concerns about the economic outlook. Today's data showed a breadth of moderation in price pressures, which will provide the RBA with greater confidence that inflation is sustainably moving towards a target point, said Sue Linong, chief economist for Australia at the Royal Bank of Canada. With policy still restrictive at 3.85%, the case to move to neutral sooner has strengthened despite considerable global uncertainty, labour market resilience, and elevated unit labour costs on added, predicting 2 more cuts after July, with a terminal rate of 3.1%. While Treasurer Jim Chalmers wasn't prepared to declare mission accomplished on inflation after the release, he did say that the substantial and sustained progress meant the government could now focus on some of the long-term structural challenges facing the economy. Actually, we should note that Australia is in the middle of the pack in terms of current rate settings, and that there is a widespread across central banks, although Australia's inflation is now tracking lower, in line with many other countries, despite the risks of a resurgence down the track. So the question for me is this: will the global uncertainty that we've seen in recent weeks, driven by conflicts in the Middle East and Ukraine, and the US trade wars, which could hot up again in early July, be diluted sufficiently by the RBA's reading of the local data to cut rates? And will these cuts be passed on to mortgage holders fast enough to take the sting out of the heavy demands on household cash flows? If the answer is yes, then arrears will probably ease down and we will continue to muddle through, even though higher home prices ahead will follow. If not, arrears could rise further and more households will need to sell. If this occurs, then prices could be weaker and arrears higher. This, of course, is excluding the thought that there could be another black swan event which could come over the top and, well, reset expectations. Once again, we certainly live in uncertain times. Now, if you're buying your home in Sydney's contentious market, you don't need to stand alone. This is the time you need to have Edwin Almeida from Ribbon Property Consultants standing alongside you. Buying a property is both challenging and adversarial. The vendor has a professional on their side. Emotions run high, price discovery and price transparency are hard to find, and then there's the wasted time and financial investments that you make. Edwin understands your needs, so why not engage a licensed professional to stand alongside you? With RPC, you know you have experience, knowledge, and master negotiators looking after your best interests. So shoot Ribbon an email at info@ribbonproperty.com.au, and if you use the promo code DFAWTW/Martin, you can get a 10% discount offer. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.